Well, as investors, we plan on enjoying this ride. This ride is full of cash from Congress and in the forms of stimulus and infrastructure and incredible liquidity from the Fed. And I think it would be foolish for investors to ignore those huge short-term boosts that are being provided. It's candy for investors, and it's really hard to invest against both of these huge forces. But to look down the road and to think that the incremental regulation or incremental taxes and massive spending doesn't have costs, I think is a bit foolish. I think this has become more of a trading opportunity. We're not getting off right now because markets can remain exuberant for longer than they should be. But I think investors just need to be aware of that, especially with all the new investors in this Robinhood phenomenon. A lot of these investors, they haven't been through a bear market. And it's going to be very interesting to see if we get price momentum to the downside, how investors react.
It's easy to say, Mark. It's easy to say, but it's market timing at this point, right? I mean, where does the short term stop and the medium to long term start? How exactly then do you strategize around, do you start to cull profits, take money off the table? At what point? And at what point do you say, hey, the ride is over, now it's time for that rationality to set in?
Well, that is the question. And I think one of the ways you start doing it now, if you're managing money, is you're talking to your clients about that. You're bracing themselves for the emotional ride that's ahead and taking their temperature if they want to stay in the deep end of the pool or if they want to start pulling back. You can also employ strategies with downside capture, and you can also look at stocks with lower valuations, not be a part of this froth that has developed. Avoid the high-flying IPOs and look for more grounded investments that would have a little more downside should things begin to unravel.
What are the warning signs? What exactly are the things, the factors you're looking for in the market or individual industries that could tell you that it's time to now shift more defensively?
Well, as I said, I think these are more intermediate and longer term problems, but we're looking at the weakness in the dollar, how far that's going to drop. That could be a concern because it's inflationary. Looking at early signs of inflation, looking at what tax bills come out of Washington. This is what we're listening for. And I'm also concerned about the regulatory environment. We had some really great picks that the market liked from this centrist perspective, Merrick Garland, Janet Yellen. But it's who's going to head up EPA, labor, who's running Senate committees. This is where a lot of the meat comes from. And if we're going to get tenor and tone and hardcore regulation that's negative, investors need to know. I mean, it was only 5 years ago that banks were setting aside billions and billions of dollars in fines. Are we under the impression now that that's long gone history, never to return? I think investors just need to go in this with both eyes open, be aware that we have some really big stimulus coming. We have a super accommodative Fed and an improving economy. But Wall Street is not a one-way street, and they need to get in touch with their risk tolerance as things develop.
Shepard Smith here. Thanks for watching CNBC on YouTube.